Hey everyone, it's Joe Stenevec. Hope you're all doing well. Obviously the market's been pretty volatile of late, so I wanted to send out a quick video just kind of to help try to give you some perspective, which I know in times of uncertainty can be pretty hard to do, but nonetheless I still wanted to do that. I just have a couple of slides to show you, and I'll try to make this a quick update. So this first slide is just looking at the wall of worry that is the stock market. Volatility and drops in investing, that is a feature. The stock market is not going to deliver, 10% returns over the long term, at least what it has done in the past. It's not going to do that without any volatility. So investing in volatility, that's a feature. It's not a bug. And sometimes I think when things are quiet for an extended period of time, it's easy to forget that. So these are just major market events where people potentially thought the world was coming to an end. Again, market climbs a wall of worry, and there's some major events in here, and lo and behold, the market continued to climb higher over time. This next one is looking at bull and bear markets. I sent out a video a couple weeks ago just kind of defining a correction in bear markets. You can go back to reference that, but the point of this is that there's a lot of blue. The blue is the bull markets. The average bull market lasts 4+ years. The average bear market lasts less than a year. Bear markets come with an average drop of 32% approximately. Those are typically in recessions when you have those 30+% declines. Are we going to have a 30% decline this time around? I have no idea. Is a recession coming? I don't know. I will say the odds are increasing for sure, but we don't really know. But it is important just to remember that despite that, the market tends to go up a lot more than it goes down. Okay, 2 more slides. This one is looking at some of the worst days for the S&P 500 going back to the 1980s. There were some pretty dark single day declines, some dark days in here. Just thinking about COVID, for example, the stock market, how volatile it was that March. But the point is that when you have those major drops, typically what happens is you have better than average returns in the future after that decline. 1 year later, 3 years later, 5 years later, you can see the numbers. But 1 year later, the average return for the stock market's over 30%, well above average, 3 times the average annual return. 3 years later, 5 years later, etc. So the point is that usually when you have major drops, like, we've had a pretty major drop, that typically translates to better than average returns looking ahead. And it doesn't mean that we're out of it. We could go lower before we start to go higher, but it just means that the average return typically after you have this type of decline is better than average. Okay, last one and I'm done. $10,000. If you invested $10,000 into the S&P 500 on December 31st, 1979, and you just left it alone, and you looked at the balance on March 31st of this year, $1.635 million. $10,000 in 1979 turned to $1.635 million. Yeah, maybe a little bit less now since the market's off 8%, whatever for in April. But the point is that, yeah, you did pretty well. But what if you missed the best 5 days or the best 10 days, 30 or 50 days? It's a dramatic difference. If you only miss the best 5 days, and this is back to 1979, that's 45 years ago, 46 years ago, 46 years ago. So that is a long period of time. And just the best 5 days, 1.03, 1.01 million. Here's the thing. Those best days typically are in times of major market events. And when I say major market events, I'm talking about declines. So you have maybe some sort of resolution would be one way to put it today, or negotiation, whatever you want to call it. But that could lead to a pretty violent snapback the other way. And if you miss those best recovery days, it dramatically can change your outcome over the long term. And that, to me, is the biggest takeaway with all of this, is why it is so important to try to stay invested. Despite people saying, oh, just get out and then get back in, when you get back in, when things are calm. That typically means when it's higher, therefore you're going to probably miss some of these best days again, and it has dramatic impact. That's it. So if you have any questions, concerns, comments, anything you want to talk about, anything about your accounts or just your frustration, whatever it is, by all means, do not hesitate to reach out. I'm here for you, and I hope to catch up with you soon. Take care.